So now, as always, we like to start off with the summary page of just the key pieces when you look at mobility. And when you look at the gasoline front, kerosene, distillate, and residual, you can see that on the average level, we are now tracking lower than where we were in 2019. And then, the daily number, then the average is dipping in the wrong direction when you're looking at what normally happens against this point in time. So this is something where we do expect to see a little bit of a bump in gasoline demand as we go into next week and the week after. But distillate's the one that's going to remain a bit softer, especially when we start talking about trucking and what some of those leading indicators are talking about. Now, FreightWaves has done a great job of talking about it. We have two of their slides that were on Twitter that I thought were really good at kind of giving some of that future of why, July and August are going to be a bit softer. Typically, June is the best month of the year, and we're just not seeing that. So again, diesel, if you remember in 2021, when you look at that yellow line, gasoline was a bit softer, but diesel was just running white hot. And now we have gasoline running well below 2021 levels, and now diesel's running below 2021 levels. So we do expect that to dip and hold just below that 2021 yellow line. And we'll go through some of those key aspects as we go through the remainder of this particular segment. Now, when we look at distillate, there was a build of 730,000 barrels. You can see that against the 5-year, that's 31.8 million below. And a large part of that remains with Pad 1, or that East Coast piece. When you look at Pad 1 being at about did have a build of 1.18 million, but we'll look at that pad specifically because we want to break it between Pad 1 and Pad 3. Pad 3 had a drop of 1.52 million, but it's still very normal along the 5-year average if you want to look at that as of where it's just 5 million below. But Pad 1 is 19.5 million below. And again, there's the difference between the haves and have-nots depending on the location. But holistically, when we look at all of the storage together, you can see that we should be getting builds right now. So the build is very normal. The size of the build is also normal, but we need to see that accelerating because you can see the pace against that 29-year average, that white dotted line, continues to move parallel with each other, and you really want to see 2022 closing that gap, and we're just not getting it. Imports do remain elevated against normal. They did have a small drop of 63,000 barrels a day. We expect that to remain well above the 5-year as we pull from the international market, especially into Pad 1, where we'll see more and more coming from both Asia as well as the Middle East as that flow comes into the Atlantic Basin, and there's that competition between Northwest Europe and the East Coast. Production of middle distillate dipped slightly to about 30.3% of yield, where gasoline had a big increase of about 1.5%. So again, you're going to see this gasoline. We do expect the normal split to be about 60-31. So 60% will be gasoline, 31% or so will be distillate. And remember, there's that 2-to-1 aspect where for every 1 barrel of distillate, 2 barrels of gasoline. So again, they're going to try to manage that as closely as they can, but organic chemistry can't be adjusted to too much. So now when we break down the different pieces, you can see that Pad 1 still remains at a 29-year low. This is where the problem resides, and it's just a matter of how quickly can that be closed, especially as we prepare for heating season as we go into the end of the year, because again, heating oil is still consumed most readily in the New England area, or Pad 1A if you want to look at what the different breakdowns. Pad 3 had a drop, but again, you can see it's still fairly above the 29-year average, still relatively fixed. And the back and forth is going to be what is going into the export market, what is going into the U.S. And it's important to understand because people will sit there, and investors and other will say, well, why is the U.S. exporting product if there's such a shortage in the U.S.? And it's like, well, but where is the shortage? Because remember, in order for pad 3 to go to pad 1, there's only two ways, I should say 3 ways to do it. One, the Colonial Pipeline. Line 1, Line 2 goes from the Gulf of Mexico and then terminates in Bayonne, New Jersey. Now, and again, there's stops along the way. There's the Jones Act vessels, because you have to use a Jones Act vessel to go from a port in the U.S. to a port in the U.S. You cannot use a foreign vessel to do that. You have to use a Jones Act certified vessel. Or you put the product on a rail car and rail it up. Obviously very expensive. So again, there's a certain limitation. So pad 3 is sitting there saying, well, we have the product. My opportunity is, do I sell it into New York Harbor or do I sell it into Europe? What is going to give me the best economics? And that's where you're going to see that management back and forth. So it's all going to come down to location as to where does the distillate flow. Now, when you start looking at products supplied, when you look at distillate, you can see that there remains below the 5-year average, and we expect it to remain at the lower end, below the 5-year average, and remain a bit softer because we do see some of this trucking slowing. Now, there was a little bit of an increase. We do expect it to flatline at about 90 to 100. When you look at market demand, there will be a little bit of an increase in June as some of those cargoes come over from China post-lockdown, and those get moved the system. But we're not going to see the same type of surge we saw in 2021, really limiting some of that underlying demand. And here's some of those leading indicators. So tender rejections have reached a new cycle low at 8.13%. We saw a pause in the downward direction since early May, but they have started their drop again, with June usually the best month of the year for trucking. So as July should be a little bit better than normal given some of the delays from China, but it just kind of points to, because July and August are usually slow months, and it just means that August could be a bit sloppy. Spot rates are also trending towards a new cycle low, and that's important to consider because spot rates are coming down as diesel continues to move up. So again, you're seeing that margin essentially get wiped out, which is going to put more pressure on the trucking companies. They've dropped over 1/3 since mid-January, so it went from $3.01 a mile to $1.95, and it hasn't broken $1.91 yet a mile yet, the cycle low, but again, you're seeing it's likely to happen as we go through the end of this summer. Retailers are largely responsible for the slowdown in trucking volumes as they continue contend with excess inventories. And based on the slowdown again in retail sales, the inventories are going to remain a bit sticky. Trucking volumes out of Los Angeles are now matching 2019 levels as imports flow in. Retailers have no urgency to move the product, so it just sits. And again, you're also going to say, well, I can truck it or I can rail it. I don't need it right away, so I'm going to wait for the rail. And that's where we've been talking about some of these slowdowns. Looking at it a bit differently, when you look at inbound ocean vessels, the worst is yet to come. Container volumes bound for the U.S., mostly retail goods, have sharply dropped. It takes about a month before this shows up in the U.S., meaning that July and August could be very slow, and we do expect to see that in August. Now, rail data, again, fairly stable. We expect grain to remain strong, farm products as usual, motor vehicle and parts as they start to try to fill some of that void, because even though sales of cars have slowed significantly, there's still an inventory gap which will remain that they'll continue to close that gap. Intermodal, again, we expect it to kind of hold just at about 2.2 to 4% below this time in 2021. Here's where we see some of that drop in June and then some of the pickup as we go into the back end of June. The back end of June is that show up from what is coming post lockdowns from China. We expect that to remain a bit elevated, but then as we just showed, that we do expect to see that sizable drop off in August. And it's important to appreciate because there is a backlog, but when you look at new export orders in China, export orders in general in China, they're in contraction. So the pent up flow is actually in a contracting amount. So we're still getting less flowing. Yes, it'll kind of be a bit of a wave because of the lockdowns, but the wave is going to be much smaller than it was in 2020, and it's going to die out fairly quickly, which is what we show, which again was going to weigh on some of that diesel demand. While when we look at natural gas, propane, you can see that there is a massive heat dome that extends from the south, southeast, way into the north. The coastal sides continue to be either at or below normal, and that's going to be, again, you're going to see a lot of that demand in that center, and we've already seen some power outages due to the surge in some of that the demand centers for air conditioning. Now shifting to gasoline. Gasoline had a small drop of 710,000 barrels, 25.3 million below the 5-year, but PADD 1 remains the culprit at 15.3 million below, which is why we are going to continue to see those imports coming in, moving to that 10-month high. Over 500,000 barrels a day is coming through. And as we were saying, imports are lumpy. That's always going to be the case. We're always going to see that lumpiness. So imports dropped 525,000 barrels a day, 105,000 below the 5-year average. We expect this to go right back to about 850 and 1 million barrels a day of imports. ARB is wide open. There's a lot of movement coming from Europe into the U.S., and we expect that to remain fairly robust. Now, blending components did have a drop of 1.43 million, but as we see that flatlining, you're going to and we'll show the different charts. You're seeing that we're following 2015 levels, and we expect to see the flat line here. And instead of getting that back, the draws into the end of August, we expect to see this remain fairly stable, get a bit of an acceleration into the first and second week of August, and then kind of flatten out and start to build once again as we go into September. Now, here's some of the culprits. I think this is always a good thing to look at. When you, as we showed this chart in April, we wanted to say, okay, well, what did they say in May? Well, you can see here that 38% of people that were polled drove less. Last month, it was 35. In April, it was 35%. So when you look at where things are going, and then obviously what is the driving reason of that you're not driving, 84% said higher prices. So we are seeing some people feel the pain, as we showed last week. Airfares have exploded. Obviously, the cost of driving has gone way up, and that is going to impede some of that normal increase in demand that we get in the summer months, which is why we're not going to get this huge demand destruction where we go to 7 million barrels a day of gasoline demand. It's just we're going to stay at 9 to 9.1, and then as we go into July, 9.1 to 9.2 instead of that 9.5 to 9.7. Again, that some of that is going to be impacted, and here is the culprit. So then when we start looking at the total inventory, you can see we're right at that 2013, 2015 levels. And then the step down below is 2014. We expect this to now kind of flatline and follow pretty closely to where we were in 2015 as things stabilize and some of these imports come through. Now, when we look at some of the driving data, you can see China still remains above normal. That we do expect that to fade back down to that 100%. And then when you look at Asia Pacific and you look at Latin America is starting to see more and more riots and protests against higher prices. And we do have an expiration on a lot of stimulus or subsidies that were done in Asia, and we think that is going to weigh on some of that demand, which is why when you look at that pink or that peach line, we expect that to drop below normal. Tom congestion showing that drop as Europe and the Americas remain below normal, and a lot of that is being driven based on price. So here, when we look at the gasoline price, the diesel price at $5.78, that is the one that impacts the inflation supply chain the most. Gasoline prices have flattened out a bit, but we did cross the threshold of $5. The average cost of gasoline in the United States is $5.01, and we do see that having staying power at these levels, impacting June before we think we get a little bit of a bigger drop in gasoline as we progress into July, while diesel doesn't really come down, but we don't expect it to go up as much due to some of that trucking issues that we've talked about and some of those slowdowns. Now, when we look at blending components, you can see that we're flatlining here. We do expect that to continue to be the case as we do have more imports and more production out of the refiners at this point in time. And then demand, as you can see, it remains well off of that normal. Still high for, at the upper range for 2022, but it should be. We're in summer. This is summer. This is summer driving. We're in driving season, so we should be at the high end of 2022. The question is, where are we in relation to normal? And you can see that we remain still well off that piece. And the workplace side is not helping, as people, over 20% of the people out there continue to not go to the office. And again, it's a rolling 20%. It's not the same 20%. There is a percentage of that is work from home permanently. But again, it's that rolling piece of that flexible schedule. Now, as we look at propane, there was a build again, but builds are normal this time of year, so it still is maintaining the pace that we saw in 2021 and slightly above 17 and 18. But again, still on the lower end, and that's 5 million below the 5-year average. And we expect that to be the case as the supply days of supply came down. And a lot of that is driven because as we have builds, we still have the big export market, which we'll talk about in the next segment. Jet stocks increased 350,000 barrels a day, 1.3 million below the 5-year, very stable. And as you're seeing here in the demand level, it's fairly flat. And again, we just don't see that adjusting at this point in time, especially when you look at where we are. As we've been saying, we will get a little bit of an edge up, but you can see we still haven't even seen that yet. And I know for those that, at least friends personally, that have looked to travel and pick up, maybe do a spur of the moment trip, looked at airline tickets, closed the website and said, well, we're not flying. So I know that there is some of that impact, which again is going to keep us, we're not going to be at 2021 levels. We're going to be above 2021 levels, but we will be below what is deemed, I guess, quote unquote, normal at that 2019 component. And you're seeing it here in terms of things are fairly fixed, 12 weeks ahead, just slightly lower, but again, continuing in the normal trajectory as the regional breakdown on open table continues to be fairly in line. Weekdays, -3, 5% below normal to about, 3% above normal. And then weekends, still staying between 5 and 10% better. So again, nothing too crazy to talk about at this point. That's what we have for you on the U.S. in general. And now in the next segment, we're going to go much deeper into what is happening with international flows and international demand as we continue through those different segments.